Hey guys, so yeah, many people are investing, and these days I get a lot of questions about investments. And REITs is this like super popular product. I don't know why. For some reason, is it because like Asians being Asians, there's this underlying desire to be a landlord, and just so happen REITs don't really require you to, take up a lot of loan and buy the whole thing, or what's going on? And many people have shared a lot of stuff about REITs online, and I'm just gonna chime in on some other points that I feel are less talked about and can definitely upgrade your game in REITs. So yeah, welcome back. Hey guys, we've finally launched our newsletter you've been asking for. Head over to thefinancialcoconut.com to drop your email to be part of our weekly TFC newsletter. You'll receive our podcast transcript, other resources to level up your financial literacy game, and some good ideas to incorporate some fun into your week. So make sure to check your various inboxes every Tuesday morning and sign up today at thefinancialcoconut.com. See ya! So good morning everyone. I welcome you to another day with the Financial Coconut. In our podcast, we'll be debunking financial myths, discovering best financial practices, and discussing financial strategies that fits our unique life. You get it. Ultimately empowering us to create a life we love while managing our finances well. And today we're going to spend some time to talk about this 3 REITs concept that I feel will help you level up your game. Okay, many people talk about REITs, and there's so much review about the different REITs in Singapore. And I think Seedly, like, my goodness, they do like review on REITs, every single REIT out there, I think. So kudos to them, good job. And yeah, it's a good reference. I think a lot of other people also talk about REITs. Of course, the fifth person, can I call them our course partner? Because yeah, we do propagate their courses, and rightfully so, because we do believe in what they are doing, and we cross check, like, make sure the course is good, right? And I think a lot of you guys have went for it and you are enjoying it so far. You learn your stuff, so that's good stuff. And for all of you who want to learn like a step-by-step how to evaluate every single in and out of, picking your dividend stocks, your REITs, your income stocks, and what have you not, the income investing strategy, you can go to thefinancialcoconut.com/dividend to find out more about the program that we are propagating with the fifth person. And also you can head to the fifth person's YouTube channel and you can search for this video called How to Invest in REITs for Passive Income, the 5 Secrets. And yeah, in that video, they will talk about property yield, cost of debt, gearing ratio, price to book ratio, dividend yield, and those are the 5 secrets. Of course, head over to the video to see the breakdown and how do they actually look at these ratios, because ratios are just ratios if you have no understanding of what's going on. Which is why I always caution over focusing on ratios and matrices, because you don't want to be blind on that. And many a times these things can be rigged and can be played around if you don't know what's going on. So I thought that amongst all these repertoire of content on the internet about REITs, a lot of people talk about REITs, so we thought that let me just share with you some other things that people don't really talk about as much to help you level up your game in the Singapore REITs market. So the very, very first concept that I feel you need to understand is this concept of capital recycling. So whenever I look into something, I always try to understand that incentive structures, right? Amongst all the different parties in that particular tool or in that particular product, right? Like what's going on in between all of them, so that I get a better understanding of why they exist, what they're trying to do, and what is their incentive structure, so that I make better bets and align myself with certain incentive structures. And so when I first got to study about REITs, one of the things that got my attention was like somehow everyone was super positive about REITs. Like REITs is this thing that, you must buy, it's just so good. And I'm like, why is it so good? Like if it was so good, these REITs are so good and so profitable, then why don't the property owners just keep the property, right? So I needed to understand the incentive structure, which brought me to this concept of capital recycling, essentially trying to understand why do REITs even exist in the first place. So fundamentally, we got to bring back to the property developer. Okay, let's just take CapitaLand as, the quote-unquote iconic property developer in Singapore, right? They develop everything, essentially. So they bid for the land, they bring in the capital, bring in the expertise, and do what they need to do and build the malls, right? So after they build the malls, what do? They go through a few transaction, right? A few like buying, selling, and they kind of essentially ride on the capital appreciation of the mall. Over time, the mall becomes capital optimized. Okay, what does that mean? When something is capital optimized, essentially means that there's limited upside to its capital growth anymore. That means the price of the mall cannot go any higher. It's capped already, limited. I mean, if you think about it, from a piece of land, they bid it and it built a mall on top of it, right? So the prices go up as they go along, right? Which is why sometimes you see redevelopment projects, right? Some of the shop houses, people buy that whole stretch of shop house, very old shop house, they tear it down, they get a license, and then they build a private condominium over in the area, right? So the whole value of the plot of land plus the property on top flip, it went up. Because it is no longer a roll of old shabby shop house. It is now, an area of like high quality condominiums. So take that same idea back to shopping malls, right? They get a piece of land and then they build on top of it. Now this is a mall, not just a barren piece of land. And then the prices of this property goes up and it's maxed out at a capital optimized level. But of course, it is not to say that the value of the property will never go up. Sometimes it goes up in tandem with the land value, or there's some refurbishment, there's some re-evaluation, or around the area, other malls are so higher and then it goes up, So it's a lot more nuanced, but generally, once the mall or once the property is being sold to the REIT, the chances of its value going up is very low already, capital optimized. Let's say in the case of Bedok Mall, right? For all of you who know, Bedok Mall, Capital Land Mall Trust, okay, or Capital Land REITs, or Capital Mall REITs, same shit, okay? CMT is the ticker. They bought Bedok Mall from Capital Land in 2015 for $780 million. So what happens? The REITs, the Capital Land Mall REITs, pays Capital Land $780 million to own Bedok Mall. Okay, and then the 780 million goes into Capital Land, and Capital Land will then take this money to develop other properties. And if you go and look at Capital Land Mall Trust 2018 annual report, okay, the valuation of Bedok Mall, okay, on 31st December 2018 is $784 million. So it's about the same, right? In 2015, they bought it from Capital Land at 780 million. In 2018, end of 2018, the mall is still valued at about 780 million. And this is important to understand, because when you understand this concept, you understand why REITs even exist in the first place. So when the property is already capital optimized, the property developer no longer makes any more additional yield from capital appreciation for holding on to the property. So what they do, they sell to the REITs, whatever REITs that they work with or they sponsor, they encash, and then they take the cash to develop other properties, while at the same time continue to manage the property and make management fees under that REIT. And I'm not like propagating this like conspiracy theory and saying that this whole thing is a sham and a scam. It's not. I'm just helping you understand the different parties involved in this tool so that you make a better decision. So now that what is the incentive of the property developer, what is the incentive of the trust, the REITs, and what is your incentive, then you can better align this whole thing. Which is why when you buy a REIT, you can almost forget about capital appreciation. When you buy a REIT, you are mostly looking at rental yield, right? So you need to understand the tool that you're owning, understand why this tool exists, what is the structure behind, who is involved, and then you can better use that tool, rather than just blindly looking at ratios and matrices and making your bets, right? Because I hope that by understanding the whole concept of capital recycling, you get to understand why when people say you look at REITs, you can forget about capital growth, because they usually are capital optimized. You must look at the sponsor, because depending on who is the sponsor, what kind of property will end up in the REIT. And generally just understand why all these matrices exist, what are people looking for, and get a better grasp of what you're actually doing, right? And if you have any other more detailed question about specific REIT or specific sector of REITs, definitely come to our community Telegram group and just gonna post your questions there. I'm sure a lot of people will be happy to share with you their thoughts. Which brings me to point number 2. The next concept that you need to understand to level up your game in REITs is that gearing ratio can be easily manipulated. Why do I point this out? Because a lot of people are talking about gearing ratios. So after the break, after a word from our sponsor, I will come back to you with the point number 2. Good day, guys. This is Reggie, your podcast host, and I want to take this time to give our mini campaign on Ko-fi.com/thefinancialcoconut a shout out. Help us reach our $500 goal so that we can integrate new softwares and hardware for your improved learning experience. We will be releasing more varied content in due time. Stay tuned. Link is in the description below. Okay, so essentially gearing ratio is total debt divided by total equities. It is just trying to measure how much debt does this REIT have relative to the size of the REIT. And why do I bring this up specifically? Because a lot of the content that I see online always talk about trying to find gearing ratio that is lower. Because there is a cap to the gearing ratio, and rightfully so, because when you cap the gearing ratio, you're essentially limiting the amount of debt that the REIT can have. And once again, when you see this view, you start to realize, why a lot of these property developers want to have their own REITs, because when they have their own REITs, they can take on more loans, right, and buy more of their property from their original property development company, right? And then they can unlock more cash, more capital to develop more properties. So it's a cycle, which is also why, it is good to have these kind of like caps on gearing ratio, the amount of debt you can have in a REIT, so that, companies don't overexploit this REIT structure lah. And I specifically bring the gearing ratio into focus because a lot of websites and blogs and, even Seedly and the Fifth Person, they all talk about finding tools, finding REITs that have low gearing ratio. The cap is 45%. Some people look at 40%. Some people look at 35% as a good benchmark. So for me, it is good. It is good to find gearing ratios that are lower. That means the REIT is not overly taking on too much debt. So I think that is fine. But you need to understand that, right? It is very easy to manipulate this gearing ratio. Okay, and not easy like piak piak like clap hand suddenly the ratio changes. No, but it's like the REIT can sell more equity, sell more of itself to raise money, right? And then in that sense, the gearing ratio will come down because it's total debt divided by total equity. So now that there's more equities, gearing ratio come down. And it seems like it's a healthy company because gearing ratio is lower, but in actuality, they just sold more of themselves and it dilutes everybody. Because if there's 10 properties shared amongst 100 people, now they sell to another 100 people, then there'll be like 10 properties shared amongst 200 people. Of course, that is an oversimplified case, but you get the idea, right? Now, you are sharing the properties that are in this REIT with more people because more equity is out there. So it looks better because gearing ratio is lower, but in actuality, it may not be because, you're sharing with more lah. So your dividend will come down and whatnot lor. So when I look at it, I think it is more important to understand why the company needs more money, whether is it when it's taking on more debt or whether is it when it is selling more equity to raise more cash. I want to know the expansion plan. I want to know what they are doing, right? And just kind of see where they're heading towards and does it fit into my investment palette rather than blindly following, things like gearing ratio lah. Specifically gearing ratio, because the other stuff I think quite logical, amongst what the Fifth Person talking about, like property yield, cost of debt, price to book ratio, dividend yield, all those things I think more people can understand. But gearing ratio, when it is a lot more, financial management, when you look at it from a debt management viewpoint. So definitely look beyond the ratio, look into why the REITs is raising money. Are they prudent with their capital and are they expanding into the properties that you believe in? Do they stick to their investment theses, right? Rather than blindly follow different ratios and matrices. Which brings me to point number 3 is that you cannot confuse the business that rents spaces in the property and the rental business of the property. When you buy a REIT, right, you're essentially owning the property and the business of the property is the rent, right? So they rent out the space and that's all it is. Why I specifically want to talk about this, because I hear things like, people telling me, hey, you should buy DC REITs because, the whole computing, IT, technology, more data is going to go around, right? And it's a growing thing, e-commerce and everything. So, owning data centers is good. Right, but the reality is you don't understand how data centers work, right? It's a lot more complex when we talk about connectivity, when we talk about things like, data center, different levels of data center, and who owns different racks in the data center and different stuff. It's a lot more complex, right? And of course, I'm not saying that as the whole digital business grow, it doesn't affect the data center business. It does, but it's not direct. It doesn't mean like, everybody's going e-commerce, then therefore there will be, therefore the rental business of data centers will go up. There are a lot more tiers in between. Much like the malls, when people tell me, oh, you should sell your mall REITs now because, people are going online, nobody's going to shop and all those kind of stuff, which is not wrong. It may affect, the rental business of the mall, but it is not a direct thing. There are a lot more nuances in between. If people don't go to shop, then the shops may close their business and stop leasing the space from the property, and then that affects the rental yield of the property. Importantly, you need to recognize that your incentive only ends at the rental of the property. It doesn't matter the business, that rents the space do very, very well. Like let's say healthcare do very, very well. It doesn't mean that the REIT is going to make more money. It's going to charge the same thing more or less because for extended arrangement. Or it doesn't mean that, because some of the shops in the malls are closing down, then definitely will affect the rental business of the malls. Because sometimes when it close, other people come in and rent. So more importantly, I think when you look at the REITs, you need to understand that your incentive stops at the property, the rental of the property. So what you need to look at, right, is pricing power. How much can they consistently charge for rent? Can they keep increasing rent aligned with inflation, or can they keep raising the rent at the at a higher rate? Number two is the tenancy length of the rental agreement. Right? Are the people that are renting the property, going to be rental for a longer period of time? Then that will kind of help them withstand the current choppy period. Right, so recognizing that this is what it is, that when you buy a REIT, it only stops at the rental, you get a much clearer idea of what to look at when you're analyzing different property. So yeah, I'm gonna sum up today. These three concepts probably will help you level up your game in the REITs space. And number one is to understand the concept of capital recycling, right? Because a lot of malls are already optimized, or a lot of properties are optimized when they are sold to the REIT already. That's why there's limited capital appreciation from the property value, and also people focus on the sponsor for this reason. And number two is that gearing ratios can be manipulated. You want to see that the REIT is being prudent with their capital rather than just focusing on like, oh, must keep the gearing ratio low, because they can always sell more equity to adjust the gearing ratio. And number three, do not confuse the business that rents space in the property and the rental business of the property. Your incentive as a REIT only ends at the rental of the property. Okay, so you want to see things like pricing power, you want to see things like tenancy agreement, how long are people renting, and how much power, can they continue to charge their tenants. And I hope you learned something useful today. See ya! Hey, I hope you learned something useful today and truly appreciate that you took time off to better your life with the Financial Coconut. Knowledge is that much more powerful and interesting when shared, debated, and discussed. I hope you would share what you've gained with people you love, and I want to hear from you. Give me some questions and help me along with building a community of financially savvy coconuts. I hope together we can fulfill our curious minds and our desire for clarity. Join our community Telegram group, reach out to us on Facebook and Instagram. Everything is in the description below. If you enjoy the podcast and feel you want to keep us growing and stay independent, do buy us a Ko-fi at Ko-fi.com. With that, have a great day ahead, stay tuned next week, and always remember, personal finance can be chill, clear, and sustainable for all. Test. Okay, so I hope you learned something useful. Of course, REITs are a lot more nuanced depending on different kind of REITs. Come to the Telegram group, ask us questions on different REITs, and we hope to help you along with that. So next week, we're gonna have a good friend of mine to come on the show to talk about to make a base case for university. I know because a lot of you guys are like thinking of like further studies or thinking of like whether is it an MBA, whether is it a university like a bachelor or whatever you're considering. I know generally on the internet the base case is you shouldn't go to the university because there are more ways to learn these days, and you rack up some debt, which is not wrong, but I feel like we always try to air the other side of the thought, right? So Ben is going to come on the show next week to provide you a base case as to why you should go to university. How do you benefit to the maximum when you are in the university, and what can the university better so that it can continue to benefit its students and stay a vital part of our social system. So yeah, those things will definitely help you to make a better decision, in progress for life. And yeah, I hope to see you next week and join us again. See ya. Bye bye.